So this slide here shows how Federal Express records its property and equipment at its original cost, and then it subtracts the accumulated depreciation. Again, remember, accumulated depreciation is the amount of depreciation taken against these assets over their life. Depreciation is a calculation internal to the company, and the cost of the asset less the accumulated depreciation does not necessarily represent market value of the asset. So like what the asset could be sold for in the day-to-day market. The net value is what was the asset was purchased for minus the depreciation taken over its life. Let's do another check your understanding. Which of the following is equivalent to the book value of an asset? Is it the cost of the asset plus accumulated depreciation? Cost of the asset less the accumulated depreciation? The estimate of time that the asset will last? Or the cost of the asset divided by its life? So I hope you get that one right. It's the cost of the asset minus the accumulated depreciation. The book value. It's also called carrying value. Okay, we're now going to move on to the deferred revenues, which is another adjusting entry. We record deferred revenues when the company receives cash in advance from a customer for products or services to be provided in the future. When customers pay cash in advance, we debit cash and we credit a liability called deferred revenues. Now, this liability reflects the company's obligation to provide goods or services to the customer in the future. Once it has provided these products or services, the company can then record revenue and reduce its obligation to the customer. The adjusting entry for a deferred revenue always includes a debit to the liability account because it's decreasing the liability, and a credit to a revenue account because it's increasing the revenue. Since it has performed the service or the taking care of the revenue, it can now reduce the obligation. So on December 23rd, Eagle received cash in advance from a customer of $600. At the time of this transaction, we credited deferred revenue, which is a liability. By the end of the year, $200 of those services have been provided. So we need to reduce the balance of deferred revenue for that amount. We do that with an adjusting entry. We debit deferred revenue and we credit service revenue for $200. The debit to deferred revenue reduces its balance now to $400, which is the amount of services we still owe the customers. The credit to service revenue records that the services have been now provided to the customer. Now, this illustration here shows an example of deferred revenues for Netflix Inc. The annual report states deferred revenue consists of membership fees billed to members that have not yet been recognized, and gift and other prepaid memberships that have not been redeemed. Now that we have discussed prepaid expenses and deferred revenues, we're going to now take a look at two other categories of adjusting entries: accrued expenses and accrued revenues. Let's now work on an exercise. We're going to look at various situations for Shocker Company, and we're going to record the necessary adjusting entries. Now, nothing was made, there weren't any entries that were made during the year, so we're going to do them all at the end of the period. So here's the first one. On November 28th, 2018, Shocker receives a $4,500 payment from a customer for services to be rendered evenly over the next 3 months. Deferred revenue is credited. So we received money that was given to us previously for us before we performed any services. Now it looks like services have been performed. So we are going to, let me just look back here, even over the next, so it's going to happen over the next 3 months. So we have a flat amount per month of services that will be provided to Shocker, $1,500 a month. Well, now December 31st is here, and we need to record that in fact 1/3 of that $4,500 has been earned. So in order to do that, we are going to reduce our liability. To reduce a liability, we debit it, because a normal liability account has a credit account. So we're going to reduce it by the amount we have in fact provided services to, of $1,500. So we debit that deferred revenue and we credit service revenue. We're adjusting the deferred revenue because now $1,500 of that liability has been earned. Next, on December 1st, the company pays a local radio station $2,700 for 30 radio ads that are to be aired 10 times per month throughout December, January, and February. Prepaid advertising was originally debited. So 10 ads a month, 30 ads in total, $2,700, which means that would be $90 an ad. So now it's December 31st, 10 ads have been satisfied. So we need to now show that a portion of the prepaid advertising is no longer an asset. We've utilized that expense. So 10 ads times $90 an ad is $900. We're going to increase our asset advertising expense by debiting it for $900. We're going to reduce our asset prepaid advertising. I don't know if I said that wrong. We're going to increase our expense account by debiting it. We're going to reduce our asset by crediting it to adjust our prepaid advertising. Now we have employee salaries for the month of December totaling $8,000 that are going to be paid on January 7th of 2019. So the problem here is we want to report this salary expense in the current period. And so we want to show the amount of salaries that were in fact incurred in December, during December. So what we do is we have to show a salary expense, which is an expense, part of the income statement. Expenses are increased by debiting them. And since we know that is not going to be paid until January, we want to create a liability. We credit salaries payable for the same amount. So that way we have increased our expense and we have increased our liability as of the end of December. On August 31st, 2018, Shocker borrows $70,000 from a local bank. A note is signed with principal and 9% interest to be paid on August 31st, 2019. So basically, we started a note in 4 months prior to the end of the year. And it was a $70,000 loan. The note was 9% over the entire year. We have to take and accrue interest, or report, I should say, the interest expense on the note for September, October, November, and December. So $70,000 at 9% would be $6,300. We are going to take 4/12 of that amount, because, or 1/3 of 6,300 is 2,100. As of December 31st, 2018, we have incurred interest expense on this loan of $2,100. So we want to show accurately for this year that interest expense of $2,100 has incurred. We will show the payable, interest payable. Now, we're not going to be paying that note for a while, but we can show the liability that we owe interest on that note as of December 31st. Okay, so when company has a cost that helps to produce revenue but hasn't yet paid cash for the cost, it needs to record the cost as an expense and also a liability for the amount owed. So as you can see, we just did that in the examples previously. This is referred to as an accrued expense. Now, the adjusting entry for an accrued expense always includes a debit to an expense account, which increases the expense, and will always include a credit to a liability account, which increases that liability. Eagle pays total salaries to its employees of $100 per day. For the first 4 weeks of December, Transaction 9 on December 28th recorded these salaries as a debit to salaries expense and a credit to cash for $2,800. So the salaries were paid, but now we have 3 days in December, December 29th, December 30th, and December 31st, where employees earned additional salaries of $300. But Eagle's not going to pay them until the end of the week of January 4th. However, Eagle needs to record the $300 of salaries expense in the period when they worked, which is the month of December. So, in other words, the company has to accrue the expenses in the same period when the work took place. The end of the period adjusting entry for accrued salaries is going to be a debit to salaries expense and a credit to salaries payable for $300. Remember, accrued expenses will always have a debit to an expense. They will always have a credit to a payable. So what do you think here? If a company pays an employee $100 per day for the 5-day work week that runs from Monday to Friday, and December 31st is a Tuesday, what is the amount of the salaries adjustment, assuming that Friday is the payday? So what that means is the month still has 2 days in it that salaries have been accrued but have not yet been paid. So we have Monday and Tuesday, Monday the 30th, Tuesday the 31st, that we need to prepare an adjusting entry for. Salaries expense would be debited and the payable account would be credited. Now on December 31st, Eagle receives a utility bill for $900 associated with operations in December. Eagle plans to pay the bill on December 6th. Even though it won't pay the cash until January, Eagle needs to record the utilities cost for December as an expense in December, since it occurred in December. Eagle records the corresponding obligation to the utility company at the same time. The journal entry to record this accrual includes a debit to utilities expense and a credit to utilities payable of $900. Now, in transaction 2, Eagle borrows $10,000 from the bank to begin operations. Assume the bank charges Eagle annual interest of 12% per month, which is basically 1% a month, on the borrowed amount. Interest is due in 1 year, but repayment of the $10,000 borrowed isn't due for 3 years. By the end of the first month, the loan has accrued interest of $100. And we know it's accrued interest because the loan was $10,000 times 12% interest rate annually times 1/12 or 1 month out of 12 months. So we know we have accrued interest on this note. Although Eagle won't pay the $100 along with 11 more months of interest until a year later, it's a cost of using the borrowed funds during December, and therefore needs to be an expense in December. The adjusting entry on December 31st includes a debit to interest expense and a credit to the interest payable. This is a common error many people use, so remember, when you record interest payable on a loan, students sometimes think the credit, to take the credit, instead of interest payable, they make the credit a notes payable. But that's incorrect. We record interest payable as a separate account to keep the balance owed for the principal payment of the note separate for the amount owed for the interest. So usually with loans, there will be a portion for the balance of the loan and the amount of interest that we owe on the note. So if a company borrowed $20,000 on November 1st at the rate of 6% annually, how much interest expense should be accrued at the year-end date of December 31st, assuming no accrual has been made for the year? I want you to take some time and think through this one and see what you think. 6% annually, and if this loan was taken out November 1st, that means we have 2 months to accrue. So it's going to be $200. 20,000 times 6% times 2/12 gives us $200. And the adjusting entry would be interest expense of $200 and interest payable, a credit of $200. Accrued revenues are recorded when a company provides products or services to customers but hasn't yet received the cash. Such revenues should be recorded as an asset for the amount expected to be received. The adjusting entry for an accrued revenue always includes a debit to an asset account, which increases the asset, and a credit to a revenue account, which increases the revenue. So Eagle provides $700 of golf training to customers from December 28th to December 31st. However, it usually takes Eagle 1 week to mail bills to customers and another week for the customers to pay. So Eagle expects to receive the cash from these customers during the second week of January, but because Eagle provided the services to customers in December, regardless of when the cash is going to come in, Eagle should recognize in December the service revenue and the amount receivable from these customers. The adjusting entry is going to be a debit to accounts receivable, which is an asset, which increases the asset, and a credit to service revenue, which is a revenue account and also a part of stockholders' equity, which is credited, which will also increase the stockholders' equity account. And again, we always state the example or the memo detail that in this scenario, we are billing customers for services provided during the current period. So let's see how you're doing here. An adjusting entry would be needed for which of the following transactions? Accrued salaries, services provided but unbilled, interest accrued on a loan payable, all the above. What do you think there, guys? We've spent this chapter talking about accrued or adjusting entries. So all of these would require adjusting entries. Adjusting entries are unnecessary for two types of transactions. Transactions that do not involve the recognition of revenues or expenses. So borrowing, repaying debt, issuing common stock, and paying dividends are not part of the recognition of revenues or expenses. Transactions in which we receive cash at the same time we record revenue or pay cash at the same time we record an expense. We don't need adjusting entries then because we're going to provide the transaction at the time. If you think about these two types of transactions, the reason we don't need adjusting entries is the source documents in and of themselves will provide us with the transaction. When we borrow, at the time we receive that money, the transaction will occur. When we repay debt, we have a check to show debt's being repaid. When we're issuing common stock, we have the transaction in front of us. When we pay dividends, the transaction is there. Therefore, there's nothing else necessary to do. The transaction happens on its own. Okie doke. So the next thing we're going to look at is how we go about posting adjusting entries and preparing something we call an adjusted trial balance. We're familiar with the initial trial balance. From there, we create our adjusting entries. And then after we have adjusting entries, we then create an adjusted trial balance. Now, here's an adjusted trial balance of Eagle Golf Academy. It includes the adjusted balances of all general ledger accounts of Eagle after adjusting entries. Notice that total debits always equal total credits. And now that all the account balances have been adjusted and are at their final amounts, we're ready to now prepare financial statements. So financial statements are prepared from the adjusted trial balance. Once the adjusted trial balance is complete, we're going to create our next step. Preparing financial statements using the adjusted trial balance. Here you can see, based on this adjusted trial balance, is where we gather the information for the income statement, and then from there we'll gain the information also on the adjusted trial balance to complete our either statement of owner's equity or shareholder statement. Revenue and expense accounts are reported in the income statement. The difference between total revenues and total expenses equal net income. The statement of stockholders' equity reports the balance of common stock and retained earnings. Retained earnings includes net income from the income statement and dividends. All assets, liabilities, stockholders' equity accounts are reported on the balance sheet. The balance sheet confirms the equality of the basic accounting equation. So revenue and expense accounts get reported on this income statement. The difference again between total revenues and total expenses equal net income. Eagle Golf Academy earned revenues of $7,200 from providing training to customers. At the same time, the expenses of providing that training were $6,000. This means that Eagle made a profit of $1,200 for the period. It's really important that you absorb these financial statements and understand what information is provided to the users for each of these statements. In this case, the net income is the income statement. The statement of stockholders' equity summarizes the changes in each stockholders' equity account, as well as in total stockholders' equity and the accounting value of the company to the stockholders, who are also the owners. So as you see here, in this stockholders' equity, it was a new company, so our beginning balances were zero. So we show throughout the period the transactions that occurred. An important one that will always occur is the addition of net income for the period, or the subtraction of a net loss, less any dividends that are paid out to provide us with our ending balance. The balance sheet you saw in an earlier chapter contained the key asset, liability, and stockholders' equity accounts provided to you in a really simplified list. This here is called a classified balance sheet. The classified balance sheet groups a company's asset and liability accounts into current and long-term categories. Assets are separated into two major categories: current assets that provide a benefit within the next year, and long-term assets are those that provide a benefit for more than 1 year. Liabilities are also divided into two major categories. Current liabilities are those that are due within the next year, and long-term liabilities are those that are due in more than a year. The statement of cash flows is the final financial statement we have to prepare. The statement of cash flows measures activities involving cash receipts and cash payments, reflecting a company's operating, investing, and financing activities. We're going to look a lot more at the statement of cash flows later in this course in another chapter. So let's look at this here. Which financial statement would include a line for net income? The income statement, statement of stockholders' equity, balance sheet, or both A and B? Well, remember, the income statement provides the line for net income, and then that figure is carried over to the statement of stockholders' equity.